Module 4, what drives value? So today we'll learn how do companies create value, what are the ways, the difference between levered and unlevered returns and how to get to them, balance sheet exercises to create value, and the difference between value creation and cash generation. We will finish off with our traps and reversals staple. So the real cost of any purchase isn't the actual dollar amount, but the opportunity cost. What you could have done with that money if you invested it elsewhere. So this quote is on the concept of opportunity cost. And this is Charlie's way of saying that every financial decision has to be also measured by the dimension of the opportunity cost. Let's look into that. So this is a monthly chart of Coca-Cola. It's a 30-year chart. Obviously, a great business, a great company, and the business has been growing all this time. Berkshire Hathaway, as most of you know, has been a long-term shareholder of Coca-Cola. This is the peak of the share price in 1999. And we see that in a 10-year span from 1999, the stock, and this is adjusted for dividends, by the way, it returned a minus 12.5%. So in almost 10 years, actually 9.5 years, it returned minus 12.5%. Again, taking the same year, 1999, and moving 25 years since, the company returned 230% or a 3.3x. So 3.3x sounds good, but in the context of 25 years, it's not great. Actually, the CAGR on that is just shy of 5%. So 4.9% CAGR. So obviously, in hindsight, when looking at this purchase, you see that Berkshire could have done something else with that money. Maybe they could have earned 7%. Maybe they could have repurchased shares. Maybe they could have bought another equity. But they kept it at this valuation, and this is what they returned. So every financial decision has an opportunity cost. Warren and Charlie do regret not selling Coca-Cola at high valuations. And we will look into major investment mistakes in psychology later in the course. So how do companies create value? The valuation process is not simply about financial ratios and prices and these superficial things which try to reflect and understand the economic reality. You also have to make an assessment of that economic reality, of that value engine. So the basics is that a business lays out cash to receive cash in the future, and the return on that capital and the absolute amount of capital defines ultimate value creation. So as I say here, it's all numbers, and we can give an example. So let's look into ROI. No need to become very technical here about which ROI ROE, ROIC, or which benchmark of income. Let's just simplify. A company makes a $100 million investment and reasonably expects to make 20% on that every year for 20 years. On the 20th year, they have to buy the same machinery, investment, building, call it what you want. They have to buy it again. So assume they can replace it for 100 million. So that means in 20 years, the value of that asset was written down and depreciation per year was 5 million. And therefore ROI after depreciation was 15. ROI is very rarely fixed or linear. A lot of things get baked into that result. And depending on the type of business, cyclical, capital intensive, commodities, all these things, the ROI figure fluctuates. But for simplicity's sake, we are looking at a 20%. Differentiating between the types of ROIs, a business could have a single opportunity to build one refinery for 5 billion and make 15% a year. Another company could have an opportunity to build 1,000 restaurants or coffee shops at the same return. You value the opportunity differently when it's a one-off compared to if the company can be growing and allocating capital for 20, 30, 40 years. But is ROI the only value creating engine? Is that it? No. Company A invests 100 million at 15%, makes 15 million per year, and that drops to the bottom line. Company B makes the same investment at the same return, but it only puts 50 million down equity and borrows the rest in debt. So the simple levered return on this deal is 100 at 15% less 50 at 7% equals 15 less 3.5 is 11.5 million. So company B makes less after cost of debt on this investment, but it makes that 11.5 on 50 million. So And so their levered return or return on equity is 23%, which is higher than company A's 15%. So levered returns are after debt, unlevered returns are before debt. So a company may or may not use leverage in their capital structure, but it's important as an analyst to be able to calculate both levered and unlevered returns, as we have done here today. Capital allocation. A company has capital, and their returns and their future depends on what they choose to do with that capital. And there are many